Good afternoon, this is Blake Young with TheoTrade's nightly video for January 12th, 2023, and today we're talking about the CPI Fireworks Flop. In today's video, we're going to discuss really quickly what really came out when the CPI numbers came out and how the market didn't react to it. All eyes were on CPI. CPI is the biggest indicator for inflation. Consumer Price Index is the largest component of the GDP, as consumers account for 65% of GDP. So CPI should show us the best indication of whether we have inflation rising or falling. Now, yes, it is true that the Federal Reserve likes to use the personal consumption and expenditure CPI versus the standard CPI from BLS to determine whether inflation is strong or weak. But today, everybody was focused on CPI. We expected CPI to, one, come in at expected or higher than expected rates based off of what we've seen in the previous month. But the market was pricing in yesterday a miss, or coming in short of that CPI number, showing that inflation was slowing or even contracting. Now, as we watch this, we see a massive bullish move, a very large multiple day move, one day after the next, making higher highs and higher lows, pushing from 37.8, 37.9, all the way up to almost 4,000. Now, on today's move, if we would have beat expectations or had a better said, a higher CPI, a higher inflation number, the higher inflation number would give us an indication that the Fed was going to continue to raise rates and probably push rates up faster, which would cause the US dollar to strengthen and equities to fall. If it came in as expected, then we should be on the same track, and again, should have been seeing the market slowly push lower and the US dollar hold its support, if not bounce. But if we were lower than expected, then that would give the justification that the Fed has done its job. It's been getting inflation in check, and therefore we don't need 50 basis points or even 25 basis point rate hikes in February, March, and then in the summer. But the market did not react that way. As we watched, we had an expanding price pattern. That expanding price pattern says, look for a new trend. This new trend would argue that we're setting up for a lower high, lower low, lower close. As we look at this market, we saw it return back into that pattern, and anything below 4,200 could be a continuation into a downtrend. What happened, though? What happened with CPI? Let's first start with the CPI data. Now, this is directly from the Bureau of Labor and Statistics, BLS.gov. It's on their news release page. It's their CPI. You can also pull this up under the CPI data. But what we want to do is we want to see a couple of things that we've talked about over the last couple of days. One is that we want to see what was the move in food, what was the move in energy, and certainly we can do X food and energy, which is all items less food and energy, as an indication of whether we have inflation or not. I disagree with X food and energy from a fundamental perspective, and I'll explain why here in a minute. But the X food and energy number came in as all items less food and energy at 5.7%. Now, that 5.7% is roughly what we saw in the personal consumption expenditure. Great. We're fine with that. But remember, this is outside of food and energy, where consumers generally spend more money on food and energy. It's the cost of the daily living. And this would be the alternative stuff, the excess in many cases. Now, we do have shelter or rent equivalent. We have medical services. But as we're looking at this, walk through this with me. All items less food and energy is 5.7. If we include some of the other core information, let's make some notes here. 5.7 here for all non-food and energy products. We look at shelter. Shelter is still up 7.5. Rent or primary residence is up 8. And then we look over here, medical is the one that's down. This is the one that's the real kicker as far as transportation services. Transportation services are up 14%. That is a massive move. The one that we saw the really offset or balance out this number is this: used cars and trucks. Used cars and trucks have dropped about 20 to 30% from last year, and in this situation, we're showing that it's down -8%. Realistically, that does not help consumers. Why? Because if they already have bought a car, they probably bought at a much expensive rate. And so this drop of 8% in used car prices does not mean that all of our costs have dropped to 8%. If people hold cars for 5 years on average In reality, over the last few years, as prices have gone higher and higher, we've created 6-year, 7-year, 8-year, and even 10-year loans for cars. This 8% drop is only going to represent a fraction of a fraction, not even the 3% that is being accounted for here. So that drop of 8% on used cars is really not going to meet the bottom line for consumers. And when we look at this for maintenance of vehicles, it's up 13%. So the ones that can't afford to buy a new car at the lower price, or a used car at the lower price, are going to have to continue to repair their cars at 13% higher than before. Now, I would point out the airfares. We talked about this in the main room. Last month, I believe, was 34%. When we adjust it for seasonality, it's pretty normal for us to have those higher numbers. This is what we talked about. 34% really was negative 3% for month over month, saying look at November to November. It was a decline of 3%. So this 28.5% will likely show up as a negative one once we get to seasonally adjusted next month. Now, again, this is not the end of the story. I think the bigger part of the story right now is up here. It's the food, it's the energy, and it's not just energy in general, it's energy for utilities. And when we look at the costs of consumption of food, it's up 10%. So if we want to continue to live indoors and eat food, that's a problem. Now, we've heard a number of talking points about the fact that eggs are very high. Cereal is 16%, eggs are up, but overall, we're talking about the protein side of things, is about 7%. Dairy is up 15%. Costs are expensive. Going out to eat is only up 8%, meaning out of the home, but I would say that's because the producers or the restaurants are taking a hit. It's still up 8%. This is a lot more expensive than what we would expect to see with a 5 whatever percent or a 6 whatever percent average CPI. Now it gets worse. As we look at inflation pressures and we dig into the inflation in utilities, I always joke that what you want to look for in a consumer defensive situation or an economy that is showing that we're in defensive movement, you want to look at what it costs to live indoors, meaning real estate, eat food because we want to keep staying alive, and stay warm, energy, electricity, Wi-Fi for that matter, or internet. And when we look at the differences here, we can see that this last month, your energy services, your electricity and utilities are 15%, 14%, and 19%. Motor fuel is down 0.9%. That is not a big win. All the energy services are down here. And those energy services, the utilities, are up. So it appears to me the stuff we have to buy, the fact that we want to live indoors, that we're seeing rent and rent equivalent are up 8%, when we're seeing that our utilities are up 15, 14, and 19%. All of our energy costs in general are up 7%, and our cost of food to eat at home is up 10%. This is not an indication that inflation is in check. It is an indication to me that we will see more defensive behaviors. We'll see consumers start to substitute out the more expensive things so that they can continue to pay for the necessities. I'm looking at this as an opportunity indication that I will be leaning into even more consumer staples, healthcare, and utilities over the next few months. Now, the market did not react this way. It did not react saying, hey, it was as expected. It was not reacting to, hey, we overpriced in the lower or slower inflation number. It didn't react to any of the price action that did in the previous days or these hits and misses in the CPI data. Let's dig into the numbers and what happened specifically with the SPX. So as I was highlighting, the SPX was rallying, we're pushing all the way up back into the previous expansion pattern. And then today, I'm going to show you both the entire candle for the day, but we're also going to show you the intraday behavior. So this is the candle. Zooming in, this little tiny body. Yes, we traded in a 60-point range in the futures market, or sorry, a 70-plus point range in the future market, about a 60-point range in the regular trading hours according to the SPX, and we netted out a difference, as you can see up at the top, of 13 points. of less than 1/3%. From open, 39.77.57 to close, 39.83.17. Now we're talking about a move of 6 points. So from open to close, 6 points. From yesterday's close to today's close, we're talking 13, but 6 points from the open to close. Zooming into the intraday, most of us expected some sort of massive expansion or collapse in equities. The CPI data was what the world was waiting for. We've already seen the jobs data supporting it, and everything pointing that we should still continue to see Fed rate hikes. And then the CPI started getting closer, and we started to unprice or deprice in rate hikes. Now, what did we do? This is the previous day. We rallied up, put in a high here, and then as we opened the market, so the market was waiting for that inflation data. And that inflation data put a lot of pressure. As we look into the previous days, rally, 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 that was what we're seeing going on through here. Here is the close and today's open. Today's open opened right here. And the market, this was my monkey bars. And let me just move this back to the left so you can see how well it behaved in conjunction with these ranges. We opened here, and the market expected massive moves. We expected significant response. We expected to see that either inflation was strong and continuing, and their Fed was going to raise the rates, and so we're going to crush the markets, or that we got it under control, therefore everybody's happy, and we should have seen the equity spike and go to the moon. Well, we gapped up. We gapped up to about 39.80. We fell down to 39.40, rallied back up, tested a high of 39.97, and we finished out the day at 39.83. So from our open to our close, we netted out nothing. This was a complete dud. We tried to light that firework, and it went to a dud. And there was good trading. There's a lot of trading. But you can see down and back up, right to our open, and that was all we got. That was our real response. And we just chopped for hours. For about 2.5 hours. Then we tried for a high and came back up and said, no, we really need to come back and settle in here. Tried for a high again, and no, we need to come back and settle in here. So the market is indecisive. The market cannot decide what to do with this data. Cannot decide what to do with all this information. And the fact is, inflation is here. The fact is, we are still likely dealing with higher costs, but even more so in the core things we need to buy. So what are we doing? What are we looking for now? If we were to look at the 3-month comparison, that sector rotation that I like to look at, we're going to see that the same ETFs are outperforming, the same ETFs are struggling. Now, the ones that are struggling still are consumer discretionary and communications and technology. The ones that are strongest are industrials, basic materials, consumer staples, healthcare, and real estate. Now, the real estate one could be a little tricky if we continue to raise rates, but industrials and basic materials will continue to climb until we see the spending slow down, and we just agreed to spend $1.7 trillion, and until we see the spending slow down and inflation start to wane, industrials and basic materials will continue to rally while we spend. But the safer spots, the defensive spots, are still going to be in consumer staples, utilities, and healthcare. And like I said, real estate maybe. And you can see this is real estate right through here. And real estate had a wonderful couple of days, but real estate is also seeing some misses in earnings with KBH, or KB Homes today. So let's take a look at a couple of different things from the perspective looking forward to tomorrow. To do that, we're going to predict, project, and plan based off today's price action. You can see we already have that mid price. So what we're looking for, we have the mid price, fair price, and the volume almost identical here in the middle. If I anchor from the low, 39.54, and say we knew all the information, we processed all that information, and yet we could not determine a direction, then the market is balanced. And if we look at this as a balanced market, and there's a tiny bit of bullish skew that we can add to this, but if this is a balanced market, generally if it's just touching that middle bar, then I wouldn't adjust it or move it. I'd say the high was the high, the low was the low, and mid price was fair price, which is how it played out today. We can move it up just a tiny bit to get a little bit more defined, slightly more bullish skew. And this is how I treat the market for tomorrow, which means that if we get up to 40.11 to 40.25 on the S&P futures, then I'm going to be looking for short trades back down to 39.89. If we get down here to 39.53 to 39.67, I'll start looking for bullish trades back to 39.89. And I'm going to look for these swings. If it can break out, if it can break out above the 20% line, above yesterday's high, which means a breakout and close on the intraday chart above 40.40, then yes, we could be headed to 40.83, call it 49 or 4100. If we break down and sell off, the break below the 20% down here will likely break out and clear out yesterday's low as well. And that would mean we'd be going from 39.40 and trading back down to 38.80, at least down to 3900. 4,000 is a psychological barrier. We finished the day 3 points off of it, and so I'm looking for balance again. We need a breakout on volume and a close to really take a new directional trade. Otherwise, we're at a balanced number. We're at 4,000. That is a psychological balance point. And indecision proved it. If I'm looking to favor the downside, I'm going to look to favor shorting stocks like XLK or stocks in that technology sector. We're at the 100% level or 0% level. And this is telling us that we failed to break out and we could see a retest all the way back down to 119. If I'm looking for bullish, you'll see the XLP and XLU are both at fair price here at the 50% fair price. Here's XLP. Here is XLU. Or sorry, XLV. Sorry, that's what I meant to do. Healthcare. We're at the 50% fair price, and we've been stuck there. So while everything is going up and down and being a little bit chaotic, the healthcare and consumer staples are being steady. They're just holding at that fair price. Utilities, however, if we look at utilities pulled back to near this 100% level. They're currently oversold. Small confirmation on a close above 71.90 would have me looking for moves back up to 73.50 and favoring some individual utility stocks. Lastly, I want to look at XLRE real estate, where I said that it doesn't, yes, it's been bullish. Yes, it's been climbing. You can see that we are approaching the 52-week high. 52-week highs don't make me nervous as far as buying up there. It's the buying opportunity was really down here, and the secondary buying opportunity was in 39.26. But this really comes down to that cost of borrowing. And the cost of borrowing on the 10-year Treasury yield fell back to the annual low. Well, let me back out of this just a little bit. It's not the annual low, it's just the 6-month low. And so we're looking at this area, support and resistance, resistance, support, and support, and support. This is a key point. If we bounce off of 340, then we could see it climb back up to 390. That would be an increase of cost. It'd create a double bottom, and we could see a return all the way up to 433. I'm not sure that's where we're headed yet, and so I'm waiting and watching. This is fair price for the 10-year Treasury yield. This is equivalent to about a 5.5% mortgage rate. And you can see that gap down, close down, and Treasury yields means a higher demand for bonds. They're up, and Treasury yields have fallen, and that's what gave energy its bump, or real estate its bump. Sorry, real estate its bump. And it's just kind of funny because when you look at KBH had earnings and missed significantly. We expected to come in equal to what we did in the previous quarter, and we missed. We came in at 247. That may not seem like very much, but we're talking about a 15% miss in earnings, and we gapped down and traded back up into the middle of it all. This little move through here on KBH could be predictive, indicative of what we're going to expect to see on Toll Brothers, D.R. Horton, Pulte Homes, some of the larger ones in these as we get into earnings in the upcoming weeks. Toll Brothers broke out and traded to a new high despite the miss in KB Homes. So coming back into these areas, I am going to be watching for rollovers and failures going into the earnings here in a couple of weeks, or I guess Toll Brothers in a couple of months. It's D.R. Horton and Pulte that are coming up in a couple of weeks. D.R. Hortons are on January 23rd and have traveled up to almost the 6-month or the yearly high. And D.R. Horton has a lot of inventory that's going to be released on the market, so it'll be interesting to see how they withstand this. And Pulte Homes a little bit later, end of the month should be the 31st, and you can see we're coming in short of that annual high as well. These are the ones I do think you're going to have an opportunity to short. depending on what we continue to see happen, whether we see a bounce or break in that 10-year Treasury yield. The last thing I want to show you is what happened to the expectations for February on the CME FedWatch tool. You can see we have a 96% probability of a 25 basis point hike and now a 3.8% of a 50 basis point hike. If we look at this from how that's changed, a month ago, we had 50-50 odds that we were going 50 basis points. A week ago, it was 37. Yesterday, it was 23. And today, we only have a 3% probability that we're going to see a 50 basis point hike. So we have eliminated, unwound, and basically locked in that it's just one 25 basis point hike and not 50-50 odds of 50 basis points. It's a significant shift. And as we look out to that terminal rate, remember that terminal rate we were looking at was May and June. Going out to June, you can see here that this has declined as well. We had the terminal rate between 5 and 5.25, about 40% by June, and it's down to 33. Anything higher than 5.25 to 5.5 went from 18% to 5, and we really have no probabilities above that. Well, that's going to do it for us today. Be safe, be careful. It's a crazy market and a lot of reaction to end up netting out no reaction at all. We'll look forward to talking to you again next week.